Welcome to the Co-Host Bros podcast, where we break down everything short-term rentals, entrepreneurship, and building a profitable hospitality business. Whether you're a host, investor, or property manager, we share real strategies, real insights, and real experiences to help you scale smarter and grow faster. Let's dive in.
Hey everybody, welcome to episode 99. If you haven't shared this podcast or left us a 5-star rating, now is your time. My name is Matt Codd, and I'm here with Austin Spitzenberger, and we are the Co-Host Bros podcast. Today we have Dylan Burgess from C2G Advisors, and we're going to talk about mergers and acquisitions. I almost messed that up, but woo, fire.
Sorry, I couldn't be here for episode 100. Sorry, I just missed it.
You would have been episode 100, but we had to cancel 2 days ago because Austin's internet. So
yeah,
somebody else.
Man, I ruined it for him. He was episode 100. Like that's a freaking
milestone. Congrats, you guys. That's great.
My wife just texted me episode 199, so I think she could hear me all the way downstairs, unless she's sitting at the doorway. But hey, yep, 99. That was a pretty good intro. Look at that. I made that up today, Austin. I'm just freestyling every time we do this. Just freestyle.
Yeah, I mean, you keep getting better and better at it, and I feel like you didn't botch it too bad. So if I had to rate the intro, probably like a 7.5 out of 10 would do it for today. I think it was pretty solid. 7.58 is what I give you.
Yeah, but if you guys have to rate the podcast like you should be, it should be 5. I mean, just saying.
Yeah. Well, absolutely. Let's jump into it. Dylan, thanks for coming on today. I think this is going to be an awesome topic. All the buzz in the vacation rental industry lately. And yeah, man, if you want to just give us a brief background kind of on yourself and about you and kind of what it is that, you guys do in this space.
Absolutely. Yeah. Austin, Matt, thanks for having me on. Listen to a couple past episodes. You guys have done a good job of kind of spreading expertise across the industry and getting different personalities and perspectives on. So, thanks for that. I mean, I've been in this crazy industry now for about 10 years. I started in 2016, late 2016 with Vacasa. I kind of came into the industry through sort of post acquisition integration. So project management work. We would buy a company and it was like, how do we make this Vacasa? How do we keep the things that these local PMs are doing really well? And how do we kind of add fuel to the fire, either in terms of like booking revenue or services or technology? How do we kind of add on to that? And really that was when there was 2,000 units under management. And when I left the company and they were public, there were 38,000 units under management. So it's a massive growth curve. Did that until the pandemic, and then went to work for Ventori, ran an M&A program for Ventori that does a lot of organic growth. Brooke Fouts and his team do an incredible job, spun up an M&A program with them. And then one of our clients, VTrips, had raised a big $250 million debt facility to go out and acquire companies. And so I went to work for VTrips for a number of years before landing at C2G. C2G is an M&A advisory service. So we right now are exclusive to the vacation rental industry. Both Jacoby Olin, the managing director, and myself have been doing this both for about 10 years. He's primarily been on the sell side, and I've primarily been on the buy side, but I've been there for a little over 2 years. We've been growing like crazy, which is fun. As Austin, as you said, like the M&A landscape in this industry is just really, really hot right now. And so we've added 5 employees and since I started. And so we're growing really quickly. We were lucky enough to be involved with the Casa Go mandate last year. So taking Vacasa private and then working with Casa Go to kind of sell off individual parts of the portfolio and get a lot of that inventory back in kind of local managers' hands. And then, we typically will do somewhere in the nature of call it 15 to 25 transactions a year. generally representing sellers to help sell their businesses.
Okay, gotcha. So general rule of thumb, or I guess to your saying, is like if somebody was at a point where they wanted to exit their business and they wanted to sell, they would hire you to help guide them through the process of selling their business, not on the buy side, right?
Yeah, correct. Exactly. Yeah. So we're similar. Think of us as like a real estate agent in like selling a piece of property, right? We either would represent a buyer or we would represent a seller. And so, I would say probably 20% of our business today is kind of buy side, where we have some clients that we work with to go out and strategically look for and identify acquisitions, as well as kind of go through the valuation process and some of the due diligence process and contracting. But I would say the bulk majority of our business is working with sellers at different phases of their growth cycle. So early on with kind of strategic advising, but primarily as people kind of get ready to sell their business, to go through the valuation phase. We do anywhere from 30 to 50 valuations a year, and sometimes those are like, hey, I want to sell my business. What is it worth? To I want to sell my business in the next couple of years. Can we do a valuation, and can you help me kind of run a SWOT analysis? Look at some of the things that I could be doing better. Where's there opportunity for revenue that I'm leaving on the table in fees? Or, hey, like let's look at payroll margin percentage and figure out, like, am I running too lean, too fat, right? Like, where's there opportunity? And then similarly, a lot of the stuff that we do is with certain companies, it's like, trying to get to price expectations and understand kind of what that upper limit could be, right? If I run a business and I run 30 units in a really, really small market, and I want to sell my business for $10 million, right? Like that's a great goal to have. If there's not enough inventory in my market, I probably need to look at how do I expand and diversify my business into other markets to support kind of the underlying metrics to achieve that goal.
Yeah. No, that makes sense. So you guys are mostly working on the advising side, but like so you would need like a mergers and acquisition attorney or something to help with the negotiation side, because that's not what you guys do. You guys help with, hey, this is the levers I would pull to be more profitable, to make your business more valuable, this, that, and the other. Am I right on that? Or do you guys do the
Yeah,
actual?
exactly. And then like listing the business. So putting together the data room, going through the analysis, the financial analysis, assessing contracts and determining, is the structure there from a owner agreement, vendor agreement perspective. And then ultimately like talking to the buyers. We talk to private equity groups, strategic buyers, day in, day out, a couple times a week. And so we have a really good Rolodex of prospective buyers, in a sense of, who's interested in buying in X market at X size, who's the right kind of potential buyer there, as well as kind of advising throughout the due diligence process. There's a lot of kind of details as we get late into a purchase, putting things together like disclosure schedules, which is a pretty specific and burdensome process. And so we help advise kind of throughout the whole process, kind of soup to nuts. And then yeah, Austin, to your point, we've got a Rolodex of M&A transaction attorneys that we can recommend for our sellers as well.
I love it, man. For our audience listening, I'm curious. So, like, let's say they're just getting started or they've got 1 to 10 listings. Is there any nuggets that you can provide to them on things to maybe look out for, or what should they do as they're growing their inventory that would be kind of things to keep in mind for considering building a business that they want to exit someday? Hope that question makes sense. Like, what are some things you don't know at in the beginning phases of how you should structure your business that will be more rewarding when that day comes, if that makes sense?
Yeah, it makes total sense. And first of all, I think anyone that's in that phase, right? Call it one home under management to even up to 30 or 40 units under management, depending upon, is it a condo or a 5-bedroom home? Is it in Hawaii or upper Michigan with with more seasonality, right? But I think generally speaking, that's a tough place to be, right? You're wearing a lot of hats. You're a manager that is in some cases you're the one going to clean some homes or inspecting homes, and in some cases you're the property manager. In some cases you're doing the revenue yourself, right? And so it is, I would say in that case, like it is a revenue challenge, just because you don't have enough revenue to support a broader team, right? And so, I think getting through that phase quickly is important if you want to build a broader business. Some people are totally happy to manage 5 units and it's a lifestyle business, and maybe they know all of the people that they're managing for, and it's intended to be small. I think if you want to target growing the business with the idea of potentially selling it over the long run, getting through that phase so that you can build a team, right, and have enough revenue to support some layers in management and some specificity to say, look, we have a maintenance person, right, that like our company and the product that we provide can be really sticky because we have a maintenance person that does a really good job. He's less than what we would go pay a contractor for, right? And so like there's a lot of kind of competitive advantages we can get technology stack because we get to a certain size, right, that like just doesn't make sense from a revenue perspective. If you're paying on a per unit basis, it's going to be more expensive. And so I think that growth early on is like a truly important part of the story. And then I would say, kind of on the other side and almost at odds of that is like the standardization of a product offering becomes really important. So as you're really small, you can do a lot of one-off things that don't scale because you're small. And so like you might have one way of handling a homeowner relationship where you've like given up stuff on the property management agreement, right? Like we do, custom fees, or we let the owner do this when they're really small. And then as you start to get from 10 units under management to 30 to 50 to 70, now you have all of these like kind of one-off challenges that become really, really challenging as you start to scale. And so I do think that standardization of contracts, the standardization of kind of your relationships with homeowners and kind of who has those relationships. I think that standardization will save you a lot of headache. And certainly as you get to a spot where you're considering a sale, it really helps from a buyer's perspective understand what is your core offering and what are the things that that we can be expected to do. Because when you have, you can see where this becomes a problem. But if you have 70 owners and you do 70 different things, each owner has a different set of linens that they want you to use. Like it starts to become a challenge, right, as you start to grow. So that standardization, I think, is important.
I like that. I think a lot of people don't do like the same thing. So like every house that I manage, like I put the same locks in, the same cameras system in, everything the same, because it's like I don't want to open another app. I don't want to have to deal with something different. It becomes a pain in the ass. So how do you guys get paid? So, because when you're on the selling side, you're listing the business. Are you getting a percentage on that end? And then, like, if you were to like advise me per se, I want to sell in 5 years, and we work together, would that be some kind of annual retainer, or how does that work?
Yeah, it's a great question, Matt. Yeah, I mean, from our perspective, like whether we're advising for a buyer or a seller, we have a fiduciary to that one client, right? So if we're working for a buyer, the buyer's paying our fee. We might go talk to other sellers, but like we're representing the buyer's paying the fee. And that could look different in terms of like the type of engagement that we might do. But I think to your question in terms of like working with sellers, if we're doing a valuation, we have like a discrete valuation fee. So we'll look at your financials, we'll kind of normalize your adjusted EBITDA. We'll look at kind of your profitability on a annual basis. We'll look at your contracts to say, hey, what's industry standard and industry norm here, and then we'll look at a lot of the margins and the rest of the business in terms of operations, and kind of identify things that could be improved. And so we charge a discrete fee for that. And it's something that we can, we do a number of those a year. Right now it's $2,500 fee. We run that. It's a pretty specific, it's call it a 1 to 2 week process for us to really kind of dive deep into somebody's financials and somebody's business, and kind of give them recommendations for the future and kind of a game plan to say, hey, here's what this looks like if you wanted to test the market today, or if you wanted to sell. And then if we actually go under engagement, if we actually work with somebody, typically we operate under a retainer basis. And so this is also fairly common in the M&A world, or even in the real estate world. You have a retainer. So we get retained, and typically we bifurcate that retainer to say, like, here's our upfront fee. And that allows us to kind of go to work, dive into the financials, put together a data room, put together a marketing doc, a confidential information memorandum, do a bunch of outreach on behalf, kind of host that data room, and go talk to all these buyers. So we typically split that retainer cost, and then we have another retainer if we actually, like, the seller says, yeah, this seems like a great buyer. This is the group I want to work with. Their price, terms, structure, what they're offering makes a ton of sense to me. Let's move forward into the next process. So then we would actually go under engagement with them. That process, from kind of initially looking at financials to going under offer, that's probably kind of a 30 to 45 day process, depending upon how quick we can get information. And then from there, we generally are talking about a 60 or 90 day process, where we're actually working on a pretty regular cadence with that seller, attending weekly calls, working through due diligence requests, as well as kind of negotiating the actual purchase agreement, whether that's a stock sale or whether that's an asset purchase, but kind of working through with hand in hand with legal and with the seller to kind of run through the rest of that process. And so, we might work with somebody on a 3 to 6 month basis. And sometimes things move really quickly with seasonality of the industry. You want to move before busy season maybe. And sometimes things get drawn out for whatever reason. And so, there's times where we work for 6 months with a company. And so we have that retainer in place to kind of cover our cost. And then, we get a success fee. So similar to a, real estate commission, we get a success fee based on the size of the deal at the end. That's what we're trying to, that's when everybody wins, right? The seller gets paid and we get paid. And so then we just credit back the retainer that we've made from that success fee, right? Our goal is to get a success fee. It's not anybody's goal to, we don't want to force a deal or be in a position where we're like forcing a deal to happen because we want to get paid our success fee. We want to make sure that we're doing the right deal if it's in the seller's best interest.
That's great. So you were talking about like contracts. So if a business were to be sellable, what's the best terms, as in contract length, certain things that they should have in their contract, and then also what is the industry standard? Because I've been locking in contracts at 2 years, so I'm just curious on how. I mean, I don't know if I'm doing it right. I guess we'll see.
Yeah. No, and I think those are great questions. And to be clear, I mean, I think there is a pretty big range in what property management agreements can look like. I would say, the key headline things that I would say are from a transaction perspective are like contract assignability is huge, right? Like one of the first things that we look at when we look at a property management agreement is like, Matt, are your contracts with the owner assignable upon a sale, right? Or do I have to go as a buyer, if I'm buying your business, Matt, do I have to go get written consent, or do you have to go get written consent from every single one of these owners to then transfer that relationship, right? Or do we have to do a stock sale and buy the entity because we can't assign them? So that changes the risk profile of a buyer. And some buyers prefer to only do asset purchase agreements. Some buyers are very comfortable doing stock sales, but has a different risk qualification in terms of future liability and past liability. And so assignability is big. I'd say cancellation provision is probably one of the second biggest, if not the next biggest. What happens in the event that relationship has lived on past that 2-year term, and the owner says, "Hey, thanks, but no thanks. Dylan, I know you bought Matt's business. I really wanted to work with Matt, and so we're done. But thank you." Right? Is that are they required to honor those existing reservations on the books? Because that's kind of the teeth that contract has, right? Like, that's the proof of concept, is like, give me the opportunity to manage your existing bookings, right? The M&A that's happened in this industry, I think primarily has come because these relationships are pretty sticky, right? In like so many other services, it's kind of a much more transactional relationship of like, I need my roof pressure washed and somebody's going to come out and do that, but it's not on a recurring basis. Whereas your homeowners have a relationship with you that there's a lot of touch points, both from like an asset management perspective, but also from a revenue perspective and then guest perspective. Like, we require a lot of our property managers. And so that relationship is one where there's a lot of touch points. And so that relationship gets pretty strong over time. And so it is hard to kind of break up that relationship. I think there's a lot of kind of path of least resistance. And so, there is a lot of M&A that comes from acquiring contracts with businesses. And again, like, I would say probably most companies are similar in that they get a lot of leads through new homeowners when a homeowner buys a house, and it's pretty hard to get a contract from another management company, even if they're not doing an incredible job, because we all make mistakes, and those relationships are one where it's not about making the mistake. It's how do you kind of bounce back and adjust the mistake. The upfront term is one that I would say, like, generally speaking, that 1 year initial term is like probably the standard still. I think, again, like what the notice period to provide a manager notice, and sort of what the fact that they reoccur, that they're kind of evergreen property managements, that they renew unless terminated. That's probably more important. So you're not like having to go out and re-sign these and get them active on an annual basis. Like, we've seen that. And then there's other parts of the agreement that are important, of how do you define fees as part of your commission, right? Can you charge booking fee or damage waiver fee or cleaning fee without having to kind of share that with the manager? What does the OTA markup look like? Things like homeowner insurance. Do you have the right liability minimum, and do you have the manager listed as an additionally insured party? I think there's a lot of parts of agreements that are important there, and so we do that as part of our valuation. We look at kind of those terms and say, hey, this is probably market. This over here, might require a change, and then we can provide resources to kind of work through those property management agreements to kind of make them more market norm. But that's a big part of an asset that somebody's buying, right? Is those relationships, and that's kind of the paper that signifies those relationships.
I like it. Okay, I'm pretty much on track. It sounds good to me. So my other question was to, like, referring to like teams. You were saying something earlier about like the guy, they have maintenance guy, they pay less than they would a 1099. So when you're if you're in the process of selling your business, does it make it more sellable to have like cleaning staff in-house and maintenance in-house, or 1099 contractors? Like, what's better, or does it just depend?
It's a great question. I think in general, what a buyer is going to look at is their margin in terms of profit margin from doing that, right? And like a similar operator, you guys are going to look at the same thing of like, what are the trade-offs? What are the pros and what are the cons of bringing that service in-house as we grow? Right, when you're managing 10 units, like, it probably doesn't make sense to have an in-house housekeeping team. Like, there's not enough work to really keep that team busy. And for if you've got a busy weekend and you've got to turn 10 units, like, you need a decent sized team to be able to do that, right? And so as you get larger and larger, bringing those things in house might make sense because you have the ability to control and have more impact on what that final product looks like, right? If they're employees, you can train them to a specific standard. You have more control in terms of setting that pricing, externally, in terms of what the market will bear. Whereas you're a little bit, at the mercy of a 1099 contractor or an outside service if that's not something that you have in house. And then similarly, like, you might be able to make some margin on it if you're running a maintenance program and you can pay that that maintenance technician less than what somebody's going to charge in terms of an outside vendor or contractor. Then you might be able to have a positive billing cycle that might add to your net income, right? And so those are the things that a buyer looks at. It's not necessary that there's a lot of advantages to having a good contracting team too. Of course, one of the things that we love about this vacation rental business is that it is asset light and it's pretty variable based on market changes. I mean, it's gone through several recession changes, right? And it's nice when guest demand does drop to the bottom, like we saw during COVID. That's nice that you can kind of flex your resources and your staff and your team accordingly, and you can do that easier when you have a contractor base than when you've got employees that you've got to keep food on the table and got to keep paying them.
Yeah, it almost seems like maybe this isn't the right answer to the question, but maybe situation dependent, but also, like, if you're using, like, for Matt's example, for cleaning, right? If you're using, third party cleaning companies versus having cleaning in house, like, what does that do to your bottom line, like your profitability, right? Like, that's kind of the thing at the end of the day. Because if you have 100 listings and you make no money on cleaning versus, hey, you have 100 listings, but you have cleaning in house in one geographical area, but you're significantly profitable on every single clean. I think that,
Yep.
I mean, am I on the right track where it's, like, kind of really just determined on your bottom line profitability?
Yeah. I mean, a buyer is going to look at the business based on profitability, and they're going to say, we're buying this business one because we might like the brand, we might like the market, we might like the team, right? But at the end of the day, they're buying it and they're saying, we're going to pay you X and we're going to try and go from X to Y, and we're going to try and increase the profit margin or the revenue and keep the margin the same, right? And so I would say, Austin, when you think about, we think a lot about kind of multiples on EBITDA or multiples on adjusted net profits, right? And so let's say you're getting a 10% margin on every clean because you have it in house, or maybe you might be making a 2% margin if it's outsourced because you have some costs that you're paying and they have a responsibility. Let's say that business that's 10%, like, if you sell your property management company with a 5 multiple, right? Let's say most companies that are less than $1 million in EBITDA are kind of in this, like, 3 to 5 times range of profit or of EBITDA. And so, you're getting a 5 times multiple on 3 to 5 times multiple on that cleaning margin, in addition to the other parts of your business, right? And so you can see where that kind of stacks up on top of itself when we look at really profitable companies in this industry. It's it's companies that have margin on all of the things they do: maintenance and cleaning, reservation and guest fee income, as well as potential what are the other revenue opportunities for homeowners. In Hawaii, a lot of people offer services because Hawaii, the owners pay the taxes themselves, and so they offer those services to homeowners. Same thing with, like, general contracting or being able to do remodels. There's a lot of other services that you can offer owners as well, and be able to make margin on some of that stuff as well too.
Yeah. Okay. Let's do this. That's all. That's all great. And then it leads to me kind of to my next question is like, for people listening, is there a way to very simply explain what EBITDA is, and you know, how does that translate into evaluation at different levels? Because I think it's a loaded question to say,
Yeah.
how do you evaluate what my business is worth?
Yeah.
Obviously, people pay you to do that because it's such a complex problem and there's so many moving pieces and factors into your
Mhm.
business. But if you could dumb it down, if possible, kind of like how Michael Scott says in The Office, he's like, explain it to me like I'm a third grader. If you
Yeah.
can possibly do that, I think that would be pretty helpful.
Yeah, for sure. Yeah, we can shoot for like a fifth grade target here. We'll try. Yeah, I mean, at the end of the day, you've got on a profit and loss statement, right? You've got revenue at the top. You've got all of your management commission that comes in. You've got your guest facing fees, potentially some owner facing fees in terms of maintenance and kind of reimbursable revenue. You've got your cost of goods sold, so you've got your COGS, what you're paying in credit card fees, what you're paying in cleaning, right? For that cleaning revenue, and then you've got your cleaning cost. So you've got your like variable cost that is tied to every reservation, and then you've got your SG&A costs. So you've got all of your sort of like overhead, your rent, your utilities, sort of all of kind of the payroll is the biggest one for vacation rental companies. So you've got all of your expenses, and then you get that net income line at the bottom, right? That is your profit. What we look at from an EBITDA perspective is we're trying to normalize Austin's profitability, net income, Dylan's, Matt's, and looking at things kind of across a broader scale, because with EBITDA, like taxes is a big one, right? So like everybody's tax bracket, whether you're an S corp or you're an LLC, your personal tax bracket, like there are certain things that kind of change that profit number at the bottom. And so we add back and we try and normalize that net income to get to what does profit look like for any buyer to buy this business, right? And so we adjust for things like amortization and depreciation. So kind of fancy things that CPAs do to like create tax strategies to adjust tax basis, things like income tax and interest. So whether you have a big loan on the business, right? Like that might lower your profitability, but a buyer could buy that business and not have that same loan on the business. They might own it outright. So what we're trying to do, all EBITDA is trying to do, is say, how do we normalize the profits on this business for any kind of ownership group moving forward? And then kind of the second part of that question, Austin, is like, okay, so my company is 50,000 in EBITDA, it's 450,000 in EBITDA, or it's 4.5 million in EBITDA. Like at different phases, each of those companies could be worth a different multiple of EBITDA or of adjusted profit. And the reason for that is it's different buying groups that are going to buy those companies, and it's different levels of complexity that those businesses are in. So, as you run call it a 10 unit, 20 unit company, you might be in that kind of 0 to 50,000 in EBITDA. And that's going to represent a certain level of complexity in terms of like your tech stack, the amount of units you manage, the number of markets you're in, the number of employees you have. And as you start to kind of climb up that scale in terms of profitability, you start to add complexity, and you start to add levels of diversification, either by market or owner concentration or employee risk, right? Like a buyer is going to look at that business that does 450,000 or 4.5 million in EBITDA and say, that business that's 4.5 million in EBITDA, like if we lose one employee or we lose one homeowner, or one of the kind of transition things happens from a tech stock perspective, and we have to make that change. Like, we have the revenue, we have the kind of redundancy in personnel, we have other homeowners that, like, that risk of loss is or attrition is like so much less for a larger business, and probably the profit margin is going to be larger for that business than it is in like name recognition. Like, there's all kinds of benefits of scale. But when you start to go lower, right, and it's like 50,000 in EBITDA, they've got 10 homes under management. If I buy that business and two of the homeowners leave, like, 20% of the portfolio has left, right? So it represents kind of a risk, but it also has sort of implications on, that complexity and kind of the how diversified is the company and how resilient can it be.
Yeah. Do you see like a general range of like multiples based on EBITDA? Like, I know it's like it's a loaded question too, but it's like you said less than 1 million is like 3 to 5, right? So
Yeah,
something like that. So when you keep as you climb the ladder, does the multiple get higher, or how does that work?
yeah, it does. And yeah, it's a great question. I would say it's variable. It depends on sort of, whether it's there's economic cycles that come into play, right? There's like, is there a lot of cash in the economy? Is the cost of borrowing high or low? As well as like how strong is the demand and the trend for these businesses from like a supply and demand perspective too. And so we see these numbers change all the time. I mean, this is a lot of what we do to kind of have a pulse on the market. And I would say right now the M&A landscape is pretty stable. We've seen pre-COVID, we saw kind of a pretty big buying spree. It was kind of a seller's market as a result of COVID. There was a lot of kind of concern and fear. It was kind of a buyer's market. And then post COVID, with just how the category awareness and vacation rentals becoming kind of on the forefront of people's minds, and Sonder and Vacasa going public, we've seen a lot of benefit from COVID long term. Initially, it was pretty painful for a lot of groups, but the category awareness is high. And so we have seen, and also guest demand has been high through kind of post COVID. We've seen things kind of level off and kind of normalize. And so I would say we're in a pretty stable place at the moment from an M&A perspective. So there's a lot more kind of balance between like a buyer and seller's market. And so that creates a lot more consistency and a lot more sort of mutual expectations there in terms of what those multiples are. But I would say, yeah, generally speaking, the kind of the nomenclature is that 3 to 5 times is the right number for a company doing less than $1 million in EBITDA. And as you start getting up to 5 million in EBITDA, like things start to get from a 5 multiple up to high single digits. And then there's just not that many companies in this industry that are above that. There's a few that are above 10 million in EBITDA, and that's where multiples can kind of start getting up into the double digits. But that's because it's a large operation. It's got a really strong footprint, high profit margin probably, and just the potential to grow that business is strong. The brand recognition is strong. Also, you get different types of buyers that kind of buy throughout that life cycle of a value chain of the companies, and so different groups are interested in different things as well too.
Yeah, no, that's awesome. I appreciate that. That gives me a much better understanding. I guess another question, maybe another loaded one, but it's what about people that say, let's say I'm building out, and every market's different, right? So my management company, I've got 200 listings in one area versus, let's say, 60 listings or 70 listings in three different markets. So there's the balance of maybe like a seasonality perspective. Like maybe I have 200 units in Florida, so it's very summer seasonal. And then I've got an equal amount of revenue, just say everything's equal in three different markets that makes me more seasonal. So I guess my question is for people that are building out their business, what does it look like if you're in multiple markets versus all of your units are consolidated into one market? Let's just say, given
Yeah.
everything is equal across the board financially, if that makes sense.
Yeah. I love it. No, it's, that is, an operative question, particularly for groups that are interested in growing, right? It's like, do I try and get to a 30 or 40% market penetration, which is really, really hard. I mean, this business is crazy in terms of fragmentation. There's a low barrier to entry. And so there are a lot of vacation rental companies, and, some of the biggest brands in some of these markets have a 30%, 40% market penetration. Like, that's considered pretty good, right? If you've got a, you know, 20,000 vacation rentals in your market, and you've got 200 of them, like, you're a pretty big company, right? And you're still a 1% of the market. Like, it can be pretty fragmented, and I think that's generally speaking a pretty good thing for vacation rental companies. Is there's opportunity, from at least from a supply perspective. There's a lot of key indicators that would cause somebody to put a higher or lower multiple. So let's say we've got a company that does a million in EBITDA, right? Austin, to your point, the example that you had, whether that company is growing really quickly, right? And so the next 12 months might be higher than the last 12 months. A buyer might say, look, we might normally have paid a 5 multiple for this, but we're actually going to pay a 5.5 multiple because we know the company is growing. We expect that growth curve to continue. We might pay that because the homeowners have been around for a really long time, right? There's like very little risk of attrition. There's a lot of customers that have believed in this business. It's got a really strong brand legacy, really good domain authority in terms of website, or there's a lot of expertise on the team. And I think you're hitting on another really, really good one, which is like diversification, right? And I would say if all things truly are created equal, and I might argue that it's really, really hard to, there's a lot of groups that have gone into multiple markets without like really deep penetration. And I think it can be hard to create some of those local economies of scale and have the same profit margin by running, 66 units in each of those markets. Can be harder than running 200 units in a single market where you have an office, shared services, and the ability to like drive 30 minutes to service all your homes, and you've got a team and redundancy to do that, versus running in kind of 3 separate markets. You might be talking about 3 separate offices, right? And so just your profit margin can change, I think, pretty quickly. But assuming for a second that that the profit is the same on both of those companies, then I do think you've got a really strong business from a diversification perspective in terms of the risk of regulatory or storms. I mean, a lot of us deal with hurricanes, flooding, snowstorms, fires, whatever it can be, right? Your homes aren't totally immune to natural disasters, as well as economic disasters, or COVID had a a different impact on a state by state basis. And so that diversification becomes really interesting, and so does your cash flow perspective too, right? This business is one where there are places like South Florida and Hawaii that benefit from a 365 season, and there's a lot of places like where I am on the Oregon coast, and like it mostly is a summer market.
Yeah, that's awesome. So I mean, I'm pretty much understanding, to me, like the gist of everything is really just the bottom line of how much blood you're squeezing out of your turnip, right? I mean, I do have some questions kind of about it, but I don't think it really matters. I think it really is going to depend on what's cheaper. So one of my questions would it matter does it make a difference whether there's like the employees are overseas? Most of them are overseas or U.S. based. If you're selling a U.S. based business, that was one of my questions.
It's a good one. I think it all comes down to what is the service that you're providing, right? And like, does your customer base see value? Because there's, do they see value in what you're providing, even if you're offshore? Like, cost is one thing, right? But like, are you providing the service that people expect? And I think if you're offshoring like a reservation agent that's taking a call, and their conversion rate is the exact same than somebody that's sitting there right next to you in your Texas office, Matt, and like the cost is very different, but the amount of reservations that they're booking and the total dollar amount is the same, then like it shouldn't have an impact at all. Now, what we've seen in a lot of these, these larger roll-ups, and Vacasa is an example of this, like the bigger you get, the harder it is to maintain that level of personal touch and personal service, right? And in a lot of ways, if I own a vacation rental, and it's probably the second most important, maybe third most important asset that I own, right? It's like either my own business that I own might be like high, or my primary residence hopefully is higher, and then I have a second home, or third or fourth investment home. It's a pretty important asset to me in my life. And so, if I have the ability to talk to somebody that can answer my questions, can facilitate like handling and solving the maintenance needs, the asset preservation needs, the reservation needs that I have, I think how you staff that is kind of inconsequential, and it will have an impact on your margins. But I do think that is still far and away like the two sort of competing priorities for a vacation rental company are like, can you deliver me revenue, and can you maintain the level of service that I have, and kind of the asset that I have? Can you preserve it, and can you maximize it, right? And both of those things are really important. Some owners, it might be more or less important, right? Like some investor owners are like, yeah, assets cool, but it's like, it's not my grandpa's cabin that he built, so like rent it every day. You can rent it for $99 on a Tuesday in the middle of off season. Like, I don't care. Versus another owner that might say, look, my grandpa did build this cabin. I want to be able to pay the taxes on it, but like really I want it to like stay in nice shape. And so like I might have a higher ADR minimum threshold that I want to preserve. And so, there's different competing priorities across those owners. But I do think like if you can maximize and retain homeowners with the cost structure that you have, then yeah, I think you can make decisions like offshoring, and that's not a degradation of service, but obviously the more that you can have in-house, the more you can kind of control some of the employees, and time zones become easier to control and be able to maintain again if they're in-house.
I like it. So, are you seeing? So when a lot of people are acquiring other management companies, are you seeing? Is it mostly like private equity? Or are you seeing like just like the bigger ones are private equity, and the smaller ones people might be acquiring seller financed or things like that? Can you give us more details on how people could be picking up these companies?
Absolutely, yeah. I would say in general, the larger the group, the more likely it is to be a financial buyer, and the smaller the group, the more likely it is to be a strategic buyer. Somebody that's kind of, and we've seen this happen even kind of pre expansion of M&A in this industry, right? There's a lot of groups going back to before Verbo and before Airbnb, and calling 2007-8, like there were groups that sold to their local competitor in a market, like dating all the way back, right? I would say in general there are more private equity groups that are interested in this industry, and in part, again, it's kind of that value chain has gone up, and as there's bigger companies, there's an appetite for private equity to get into the space. But yeah, I mean, in terms of options for potential buyers, like there is the option of purchasing in cash, right? Whether that cash is from a fund, right? Private equity group, venture fund, search fund, whatever it might be, or somebody's personal equity, like, hey, I've got profits in my business that are X, and I want to spend Y for a company, and I have the capital to go out and buy a competitor. There's kind of that cash. Then there's the the borrowed funds, so you can do things like an SBA loan. You can borrow from a fund. You can borrow from other investors that want to invest in your business. You can borrow from the SBA. You can borrow from a traditional lender and buy a company. Or you can do seller carried financing. So a seller might say, look, I'll sell you my business. I'll hold the note on it. You pay me over the next 2 years, over the next 5 years. So there's seller carried financing. And then there's kind of like a merger or rolling equity, the seller saying, look, I want to merge, like, let's do this 50-50 and let's run this company together. Or, I'll sell you the business, but I'll roll some equity, whether that's with a private equity group or just the buyer. Like, I'm going to take a portion of that payment and kind of roll it back into your business, either in the existing company or in the holdco, and say, I'm going to roll over some equity in your business as well. I believe in what you're doing.
I like that. I want to make it clear for everybody that there's multiple ways for you to be able to acquire a company. So I also want to make this clear too. So I'm going to ask this question. If there's people that are listening to this, which I know there are, that are co-hosting, that are not collecting the funds, that aren't managing the money, how sellable are they, and what should they do to make them more sellable at this point?
Yeah, I think it's a good question. I think just going back really quick on like one other thing, Matt, going back to your previous question, like, the other opportunity is you have some kind of revenue share over time, right? If you've got another company in your market, you can say, look, I'll pay you an X percentage of commissions that the business makes over the next 3 years too, right? So there's a lot of different ways to kind of get creative and fund an acquisition. The co-host component of this industry is one that is growing quickly, and it's solving for a really interesting problem, right? Like, so much happens for full service managers. So much happens at the company level. That ability to control the whole aspect of guests' experience is important for a property manager, but I think some is lost in terms of the homeowner's perspective of having that control and having an asset, something like a listing, right? That like with Airbnb in particular, that asset, if I go from manager to manager, like, I lose that kind of the ability to have that listing kind of convey after my next manager. Like, that is a really interesting component of management that I lose, or that I miss out on as a homeowner. And so it is something that we've seen more and more of. I think it makes the management kind of more challenging, because you've just got an owner that's more involved in sort of that service level, right? The owner sees a lot of the back and forth there. I think the potential for mistakes is higher, and so I think you've got a potential, like, riskier client there in terms of making those changes in management. Like, it's easier for that owner to leave because they have their own Airbnb listing, because they have the ability to kind of maintain those reservations, right? It's a less sticky service. And I think that's a trade-off that you make. It's good for the owner. It's probably not as good for the manager long term. But it's something that the market is, like, starting to see more and more of. And so I do think it's an interesting it's an interesting challenge. I think it does create that attrition risk. And so I think a buyer can sometimes be turned off by that risk. We sold a business last August that was primarily co-hosted. I mean, almost all of the units were co-hosted, like 94 properties in Arizona, and that business sold. So it certainly does happen. I would say there are not a ton of examples of co-host companies that have sold, and I think again it comes down to there are just less reasons for that owner to continue on with the manager and like really sort of see it through and kind of go through that proof of concept period of like look, change is hard. Like anytime, even if you do a really really good job buying a company and integrating that company into your business, and let's say you have value to add in terms of products and services and technology, you're changing that relationship, right? And that relationship is one, we humans, we tend to say we like change, and we tend to sort of like shy away from change, especially when things are going well. And so I think that's where, I would say it is less desirable of a business model from an acquirer's perspective. And I think it probably dictates a change in structure more, like in terms of earnout, more than it does in terms of price.
I feel like there's a lot of complication with it, especially when you have so many different listings that you're managing. Because most of the people who are co-hosting are creating the accounts for the owners and all these things. I have to keep track of all these emails, all these Google Voice numbers, and I just feel like it makes it less scalable.
Yeah, and it's
way.
probably less profitable in some cases, right? If you're the one getting paid and then invoicing, you don't have as much control in terms of like holding those funds and getting an interest rate on the funds that you're holding, right? You don't have as much ability to like mark up the fees and be able to kind of like manage and dictate sort of how things get costed out to the guest versus what gets paid to the owner.
Yeah, that makes sense. So generally when people exit, I mean, and I'm sure there's probably different answers, but most of the time, if most people sell their company, when they do sell their company, do they normally like negotiate to keep the manager on for a few months, or they like hire the manager, or does the manager just disappear and say, hey, screw it?
All of those things happen. Yeah, all of those things happen. But I would say in general, one who the seller is probably dictates what happens there more than anything, right? If you, Matt, are super active in your vacation rental company and you say I want to sell, it's going to be harder for a buyer if you're very active in the company to say, cool, we can totally take over your business and there's going to be no impact on the homeowner relationships or the employee relationships. Like if you're in the office every day and those homeowners call you every time they need something, like I, as a buyer, I'm probably going to push for a longer transition period or have some type of earnout to make sure that you help me make sure those relationships convey and move forward, right? So that you help kind of impart that trust. Now, if you're like, more of a strategic director in the business, you're more of like an investor owner and like you've got a team in place that owns those owner relationships, like, you might be able to go on a cruise the day after we close and like, the homeowners and the employees like don't know the difference at all, right? And so I think it depends a lot on how involved the seller is, how involved the management team is in terms of the existing homeowners and guests and employees relationships that are there. And then I think, yeah, it does come down to sort of the other attrition risks that the buyer has identified to say, hey, are these relationships that are sticky? These homeowners have had vacation rentals for 10 plus years and they've clearly shown that they want to rent the homes versus maybe their newer relationships, right? There's a bigger risk of attrition there. Maybe the employees have been there for 10 years and they've got great relationships with the employees. Like I, as a buyer, am probably less concerned about those relationships transferring.
Yeah. Yeah. So when they does it change the sellability? Like if somebody was like way more involved with all the owners, or not, or it just changed basically the exit structure?
Yeah, I think it probably has a bigger impact on structure than anything. Just again, it comes down to as a buyer, if I'm going to pay you a multiple of 5 times your profits, right? Like I'm going to hope that all of those homeowners that you have on program today are going to be there longer than 5 years, or I'm going to have to grow the business to account for some of that attrition. Um, and so I think there are certain buyers that are looking for different things, and this goes back to private equity versus strategics. If I'm in the same market as your business, Matt, and I want to buy your company, I might already have a team that's like, we might already have a corporate office. We might already have a team that kind of has some redundancies. Let's say you're really involved with homeowner relationships, and pricing. Well, I might already have a revenue manager that can like pick up pricing the properties, right? But like that risk to the homeowner part is important. And then I would say like, there's a lot of groups that are looking to put capital to work in this industry and want to back really active operators, and want to say, look, I want to buy your business. I want you to just keep doing what you're doing. And like, I'll give you some equity, or roll over some equity in your business, and keep doing exactly what you're doing. Right. And stay active, and potentially take some chips off the table, and take some equity, put it in the bank, and then potentially have a second windfall when that company kind of grows and looks to recapitalize or sell.
Yeah. Awesome. Dylan, I want to be respectful of your time, so I'm just going to ask, do you have a call coming up in the next 15 minutes?
I'm good. We can go over. Yeah.
Because I know we can kill it, but I got like one or two more, but
Sure.
I want to make sure you get to where you're going if you need to
Let's
bounce.
let's do it. Yeah, let's do it. Awesome.
Okay. So let's do this. Like what is something like you look at a lot of these deals, what is a healthy profit margin within this industry? So I'm building out a new KPI dashboard so we can start tracking profitability better than the way we've been doing it. And I'm just trying to set myself a goal. I guess every company is different, but just want to see like what do you expect where it's like, hey, you've run this, you've looked at businesses and you're like, hey, if you're at a profit margin of right here, like you're looking good. Like what do you
Yeah,
like to see for people that are tracking this?
it's awesome. We love that question, and we're building out, as part of C2G, we're building out a dashboard to kind of hopefully in the next couple of years to be able to like really tie in with PMSs and be able to like create that tracker so that it is much more front of mind and center. I think that's only helpful for this industry, and Jacoby's been really good at kind of leading the charge on that. But yeah, generally speaking, Austin, I think we talk about profit margin, and this is like just because of the industry that we're in. We think about like gross booking value, right? As like a lot of companies use that as revenue, right? Most of gross booking value gets paid to the owners because of the commission rate, versus like net revenue, right? And so I'll say, generally speaking, I think if you have a 10%, if you're taking 10% from GBV to the bottom line, if you're taking 10% from like total gross rents and fees, like the top line revenue number, like 8 to 10% is probably what we see is like a healthy margin. And said differently, so looking at net revenue, right, which would be like commissions plus guest and homeowner revenue. um in other words, like after you've paid the commissions to owners, generally speaking, that would be like somewhere between 20 to 30%, probably 20 to 25% as probably like a pretty healthy profit margin, right? So as you get from commissions and fees, if you're doing 25% of that to the bottom line, like that's you're probably doing good. If you're at 30%, you're probably like really efficient at taking that revenue and turning it into profitability.
So growth, if you're saying gross booking value, so that's that. If you're going off your gross booking income, 10%. is a good profit margin, and you're saying 20 to 25% of what number again is another good one?
Of net revenue. So yeah, so commissions plus like guest and owner fees. And that's
Okay.
generally like that's the number that we like to use. It's just, you know, the, different people run their books, and this is why we have a job in the industry, is like different people's books can look very different. Some people list cleaning fees as gross. Some people just list net cleaning fees, right? And so like again, all of these numbers are a little bit murky in terms of how we as an industry are still thinking about this. And I think we're going to get more and more consistent in terms of like reporting financials as the industry continues to develop and grow. But yeah, I think generally speaking, kind of that net revenue number of sort of how, the company's net revenue versus like the net revenue that you share with or the revenue that you share with homeowners. But that net revenue is like the right number to think about. And I think that 20 to 25% range is you're doing a pretty good job if you're taking the company's revenue and have a 25% margin on it. You're doing pretty well.
Awesome. Okay, good stuff. And then two-part to that question is whenever you're looking at these businesses, is there any overlap in some of the levers that you see that vacation rental managers could be more profitable in doing? So like maybe there's something in these businesses when you're analyzing and you're like, hey, managers aren't making money on this, and they should be because it'll make their business healthier. Does that make sense? Is there kind of an overlap in maybe revenue streams within vacation rental management companies that you see when doing these?
Yeah. Absolutely. I mean, I think all of the things that we've talked about, the more that you can control your own destiny, you have the ability to make margin on it. And I'll give you a good example. I mean, you guys have both identified really good ones. Cleaning and maintenance are two of probably, other than management commission, like, gross rents plus the times the management fee, like cleaning and maintenance are probably your two other second biggest like sources of revenue. And so bringing those in house and being able to get a margin on those is, if you're running your maintenance department at a loss, like then you have an opportunity probably to say, look, if we did all of this outsourced, what would a homeowner pay for us to provide the same level of service, right? And can we beat that? Can we still provide a better product and a cheaper product to the homeowner, but make some money doing it because we have these people sitting on payroll? Then there's a margin opportunity there. I think similarly, one of the things that we've all seen as something that's kind of come up in the last, call it 5 years, is like this industry used to be really heavy on security deposits, like very similar to leases, and like we've moved to more of a damage waiver model. A lot of groups are self-insuring it, or providing their own system to pay out those damaged funds to owners, and like that can be a really profitable margin, right? Like there's a lot of fear and concern around damage, but like in general, and of course there's outliers and it sucks when it happens, but damage in general is like the cost and the percentage of those things is pretty low, right? And so that's a profit center, and that's been a profit center for a lot of companies. Similarly, like, upcharging the ability to book reservations. So like admin and kind of reservation fees is again, like, look at what the rest of the market does in your area, and like, are you competitive on that? Like most of that goes to offsetting your merchant credit card processing fees.
I've been preaching that from the rooftops about damage waiver upsells, like upcharging damage waivers, because it's like they're so cheap. And, and if you look at it, like I was explaining to somebody the other day, like there's certain platforms you can get a $1,500 damage waiver for $37, but Verbo charges $59.
Yep.
Like, what are we doing? You could make so much money. Making 10% on a damage waiver is a piece of cake. Like
Yeah.
It really is. And I think people really miss out on that. Like they just sleep on making money on that. And I mean, I'm glad you brought it up, because that was
full
actually
coverage for the homeowner. Like it's, it sucks, like, especially, and for the manager too. I mean, like oftentimes it sucks to go track down whoever the damage waiver provider is to go like report a claim over a lamp. It's like, look, if we self cover this, like just go buy a lamp. It's gonna still be cheaper than what we provided, and it's gonna be a $50 lamp to replace. Move on.
Yeah, right now we do it all through Happy Guest, and we have them on the podcast too. So
Nice.
It's really simple. You just click a button and you put the pictures in there, explain what the issue is, and then boom, that's it. Whatever company they paid that reservation, they send you an email and you deal with it from there. So
That's great.
super simple. I actually just submitted one yesterday. But yeah, so it's great. But Dylan, dude, I think that you have dropped like so much knowledge for everybody, like especially for you guys thinking of selling or even thinking of buying. And if you want to get yourself right to sell, definitely would contact Dylan for sure. So if you want to just tell everybody like where they could find you and things like that, whatever else you got to drop for everybody. And
Sure. Yeah, I mean, for us, C2G Advisors.com, we're pretty active. We go to pretty much all of the major conferences. We're very involved in the industry. So we'll have a booth at all of the conferences for those folks that attend conferences. But C2G Advisors.com, reach out to me on LinkedIn. We'd love to talk sooner than later. We don't have to charge. We can get a sense of just kind of where people are in their life cycle. And I'm working on selling a business right now that I've been talking to the owner for 9 years. I mean, we've had a long conversation, and this industry, you want to make a decision to sell your company, and you want to do it once, ideally, and so we have a lot of people that we have a strong relationship with, and happy to talk about pros and cons of selling, and what are the things that kind of create that value over time. But yeah, look, reach out to us, C2GAdvisors.com. And then, yeah, Matt, Austin, appreciate the opportunity to come on. I mean, things like this are great for us. It's a cool industry. I've really enjoyed being in it for 10 years, and it's awesome just to see the proliferation of services, technology, and people just, saying good things about the industry is awesome.
Yeah, it was great. I mean, when you guys get a chance, you guys need to start sharing this show. So you guys need to be a bro and share the show. But with that, I'll let Austin, swipe it out. Swipe left.
All right. Thank y'all for listening. Peace.
Thanks, guys.